Hey, good morning again, everyone. Marty Missouri here for the second time today. This is your weekly economic update. This one I'm just going to kind of blow through pretty quickly. There wasn't a lot of data out this week. We still have a lot of our macro weekly analyses to do, so it's possible that if there's something I'm just dying to share with you, that you get another video from me over the weekend. If not, Monday morning, there'll be, of course, the written note. But I thought I would just kind of get this one done for you and update you on what we're seeing in the economy. Again, slow week for data, big week next week, of course, with the CPI print for May, and then the Fed meeting. So could be some fireworks in the markets this next week, but we'll wait and see and cross that bridge when we get to it. For now, in front of you is our PWA index. It actually took a step back by about 4.5 points, back down to rounded to 27 negative, firmly in the territory that says recession is likely coming in the not too distant future. I'm going to share a handful of inputs, then I'm just going to run through kind of some random charts, kind of give us a feel maybe for what the inflation print is going to look like this next week, and a few other, I think, worthy data points or data points worth taking a look at. But to begin with, just retail sales, the main number everybody is interested in comes out once a month, but Redbook actually posts weekly retail growth data, and it just continues to plummet, and it is just now barely above positive at 0.6%. And folks, just look at what it does or where it gets traditionally as we lead into recession. So this is screaming recession to us right here. Mortgage purchase applications continue to roll over. Initial jobless claims spiked up. The expectation was 235,000. We got 261,000. Again, done this for you dozens of times. The level's important, and it's still relatively low, but the rate of change and the direction is perhaps more important in terms of what it says about the go forward. So yeah, something to be concerned about for sure. The Institute for Supply Management services sector, as I've been pointing out, has been holding up really nicely, and not so much lately. Below 50 is contraction territory, and we came in at 50.3, and I'm going to give you a few more of the details when we run through those charts at the end. But I've said this over and over again as things began to break down, that manufacturing typically goes first, services typically follow. Bloomberg Commodity Index, a little bounce here off of this level, retracing 50% of its rally. A little long flag there, but it's a 50% retracement. So just technical analysis would say that if we're indeed in the throes of the early stages of the next commodity supercycle, which we absolutely think we are in. However, we think a recession will continue to weigh on commodity prices in the meantime, but ultimately we do think this is what happens for a lot of, we think, very logical, empirical reasons that we've gotten into a lot in the past, and I suspect we will be getting into more in the years to come. It's always a good idea to single out copper, and again, I pointed to where copper had broken down below support, but it now has spiked back above there. Had some optimism lately in some of the Chinese data, so I think that's been, seeing a bid or helping a bid under the price of copper. We'll see. We're bulls on copper long term. We're bears on the economy near term, so it wouldn't at all surprise me to ultimately see copper turn back around before it finds a real durable bottom long term. Okay, so just to finish up, the Daily Shot is what they call themselves. They actually do a really good job of grabbing charts from various sources and sending us quite the rundown of the previous day's data. So I like to look at that each day. It takes just a few minutes, and I grab some of those charts, and I wanted to show those to you. But first, my good friend Sam, who some of you have mentioned, you like his comments when he puts them on the bottom of the blog post. He's about the only person who comments that way. A lot of others will send me emails off and on, but I do enjoy my interaction with Sam. Really smart fellow, got some experience, and most importantly, he just thinks very deeply and reads a lot and takes in a lot and asks really, really good questions and makes good, thoughtful assumptions of his own. I believe it was yesterday he threw this out there. He said, I have a question. What do you think CPI will be next week? PCE was hot. Will CPI follow? And I said, hey, Sam, I wish I knew, but if I had to guess, I'd guess that it'll come in softer, at least on a year-over-year basis, and I want to say all things equal. One reason why is base effects, and I shared those below. I said, notice the big monthly jump a year ago, May 22. Originally I put 21, but I changed it at the year wrong. So May of 2022, below our last year's monthly CPI numbers, and I typed XXX next to the high prints. That's a high comp that all things equal would make for a lower year-on-year May 23 print. So again, all things equal, and I'm going to show you some other data here in a minute that might conflict with that, but from sheer base effects, and I've shown him that it was up 1.1% month over month, so that pushes the base from which we're going to work with on a year-over-year basis up. And then I used last March as an example. We had a 1.3%, 1.34% spike, and sure enough, the March 2023 year-over-year print just plummeted from 6% to 5%, and that's a big drop. I think something like that could happen again this month, and that'll surprise a lot of people. And then I pointed out that all things equal again, though, look at July through December. Those are very low month-over-month numbers. So all things equal, inflation probably comes in hotter than expected the second half of the year, except for the fact that if the economy is in a market slowdown, right, if we are having a recession, it's interesting to me that people say, oh, the Fed will never get down to their target. I think, of course they will. If we have a recession, inflation's going to plummet. And particularly the deeper the recession is, the more it'll plummet. I'm a real bull on inflation long term. I mean, I think it's going to be structurally a lot higher than we've gotten used to. But when we have recessions, it's going to drop. It's going to fall out of bed. Our view, though, is that because of these structural forces, it comes roaring back, kind of an early 80s scenario that maybe we'll get into in another presentation. Okay, so Nomura actually estimates an increase in core CPI. And that flies in the face of what I just said, but most of the strength will be driven by volatile components, so it could be explained away if indeed they're right. Used vehicle CPI should be strong for a second consecutive month, but turn lower in the June print, right? And I do think it's May and June where inflation can come in softer than people expect. Energy goods inflation dipped below its pre-pandemic average, so that would be a headwind for inflation here this next coming report. Prices component of services point to lower services inflation in the months ahead. Maybe it doesn't get reflected as much in May, but it does further out. And again, that completely jibes with our go-forward recession thesis, right? Shelter CPI, based on new tenant repeat rent index, they expect that to roll over as well. This is BCA research. The U.S. bond market has spoken out, break-evens and so forth, so bonds are reflecting disinflation going forward. Again, the bond market is acting or discounting for sure a recession going forward. Household interest payments are climbing, right? You can see that here. Interest payments as a percent of income, interest payments as a percent of wage and salary disbursements. Folks are paying up for their debt. Here, credit cards, 20.1% average interest rate. Interesting economic headwinds continue to weigh on mall traffic. Change in monthly visits to shopping centers by category compared to 2022. So you can see indoor malls, open air lifestyle centers, and outdoor malls in May saw 12, 7, and 11% declines versus last year, respectively. Okay, so that speaks to things beginning to slow down at the consumer end, and that's the next leg to give way in a recession. Indeed, seen the Indeed commercials, a source of employment data. Job postings keep trending lower. Wage growth is fading fast. Of course, that's a disinflationary force right there. It also speaks to our recession thesis. Morgan Stanley's cycle indicator is rolling over, right? Here it is now. Here it was before the COVID recession. And again, back in here when we were flagging this was before we knew anything about COVID coming, right? Here's before the great financial crisis. Here's before the tech bubble burst. Here's before a bit of a slowdown in the mid-90s. Here's before the early 90s recession and so forth. So that's kind of an ominous sign about the prospects for the economy right now. And then employment index shows staff reductions. This also comes from that ISM services print and so forth. So folks, I think I can leave it there. There's more, but it's just kind of redundant at this point. So, everybody's thinking about the equity market all the time. And so as I said on, I think it was Monday or Tuesday, we have a very low score on our equity market conditions index, but a couple of things, the technical look of the dollar and then Fed policy, just because they're going to pause next week, I think that's certain. That's not bearish for stocks, right? And the data that's coming out, I think for the most part, like the jobless claims today, of course we'll wait and see what CPI says, but that's supporting the notion that the Fed maybe should just kind of pause right here and let what they've done so far work its way through the economy a bit and see if it doesn't do the number on inflation that they hope it'll do, right? Well, the way the stock market has been trading of late, anything that's weak, anything that suggests the Fed softens up is really, really bullish. And that's where I think the market is really getting it wrong, save for traders who are just trying to make a buck in the very short term. Beyond that, investors, long-term investors, these rabid bulls who are saying, look at this, it's all over. The Fed's going to ease up and everything's going to be okay. The soft landing scenario is still going to be a very tough one to bring to ground, so to speak. And if what we're seeing here and the Fed's reaction and all of that we've seen of late means that recession is coming, as looks still pretty likely to us, that's really, really bad news for the equity markets because they're not priced for recession. They may be priced for a soft landing, but if we don't get it, it's that blizzard analogy that I used here earlier this week. It's in the forecast. And if it's in the forecast, have some hedges on, be diversified. Don't allocate all of your capital right here because you watch somebody on CNBC say the bear market's over and, we're going to 4,500 over the next few months. That may be true, but there's enough reason to think that we could do the opposite, that it's prudent to be prudent right here. So don't know what's ultimately going to happen, but we can gauge the risks and invest accordingly. Folks, I'll leave it there. Thank you. Really appreciate you watching and listening. Be back soon. Take care. Bye-bye.